So some of the key unresolved issues also let us see. The auto sector compensation cess, as I said, that this compensation cess has been now removed on the auto products. So all the cars are now going to be taxed either at 18% or 40%. So you know it that depending on their length, engine capacity, all that and all, the car rates are going to be. So there are going to be only two rates, 18% or 40%. So in such a scenario, what has happened that there are huge stocks at the car dealers, and these supplies were made prior to 22nd September 2025, wherein the car dealers have paid the compensation cess. But you know the legislation around the compensation cess that it can be availed as an input credit, but it can be put to use only when it is a product with compensation cess applicability is supplied. So in such a scenario only it can be utilized. Otherwise, the compensation cess will remain in your books only. So now for all these car dealers who are having the stocks prior to 22nd September 2025, substantial amount has been paid under the compensation cess. But from 22nd September onwards, the cars are not going to attract any kind of a compensation cess at the time of supply. In such a scenario, what is to be done with the money that is lying in compensation cess account is a big issue. So, as per the industry estimates, it is a 2,500 crore across India. So, whether it is official or unofficial, we do not know, but the government is thinking that how to compensate for this. But the car company OEMs may be asked to absorb this. That we got to see how it is going to happen, because they are bringing some parallel change in the credit note also. So maybe the OEMs will be, without linking to the past invoices, they can take advantage of the change made in the credit note in order to compensate the dealers regarding the compensation cess. So that we got to wait and watch. So regarding the intermediary services place of supply, amended rules now subject the foreign service providers commissions to reverse charge mechanism. So exports and service importers await clarification on valuation, documentation, and export incentive overlaps. So this is something which is going to be a problem, which I have already explained to you. So the reversal of the intermediary services, when intermediary services are received in India, they will be subjected to RCM. That something that we have to see. Cash flow issue will be there. So for the online gaming industry, the new promulgation and regulation of Online Gaming Act 2025 prohibits the real money gaming. But Supreme Court consolidation of the pending cases leaves the past liabilities and ongoing GST disputes in limbo. Now we have to see. Last week, you might have heard that the Supreme Court has called all the cases across India on online gaming to its bench. So the Supreme Court bench has already reserved the judgment on this online gaming in the last week of August. So all the rival parties have made their final submissions. Now, in the meanwhile, the government has come out with the new legislation by prohibiting the real money games. So, in this kind of a scenario, what is going to be the fate of this online gaming industry? Whether they are going to get any kind of a relief, or for the past period, whether the Supreme Court decision is going to have any kind of a retrospective effect, or what is going to be the fate of it, is something that we have to see in the coming days. And inverted duty legacy, while GST 2.0 resolves future IDS issues for fertilizers, textiles, pharma, settlement of the past refund claims and pending litigation remains uncertain for the affected businesses, because lot many cases are booked on the inverted duty refund. That in one of the webinars in the past that I have explained, that the whatever the government's subsidy, central government subsidy on the fertilizer was questioned by some states, and they have not allowed the inverted duty refunds, and on top of it that they have demanded GST on the central government subsidy on the fertilizer. So all these litigations are pending in several courts across India. But whatever is the rate rationalization the government has done under GST 2.0 is addressing going forward. But what about the past? So how these past issues are going to be resolved is something that we got to see. And e-commerce delivery services, a new service category separate from the GTA and the courier services is being established. So what is that? You might have seen that when you have forgot something like your charger at home and you have gone to your office and suddenly that you want that charger, hence you call a dunjo or a porter, somebody, then that person will collect it from your home and deliver it to you. So whether it is a goods transport service or do you call it as a courier service? If it is a goods transport service, then he should have issued a document. But in this case, that there no document gets issued. But is it a time sensitive document in which he is dealing to categorize them as a courier service? It is not so. But all these days, this particular segment of the service provider are subjecting themselves to 18% tax. Now that the dilemma is whether they should be treated as a GTA or they should be treated as courier service is the question before the GST Council. So, in order to address and to categorize them, that the GST Council has proposed that a new service category is going to be coined for them, and what is going to be the definition, who are going to be covered under it, and if these services are provided through a e-commerce portal, how their taxation is going to be. All these things, the government is going to come out with clarity. So we have to wait and see, but it is going to be separate from both GTA as well as courier services also, and is going to be a new line of service and a new definition has to be given to them. So this is something very interesting that we have to wait and see what is going to be the final print. Next slide, please. So some of the transitional challenges, what you need to keep while running your day-to-day offices is that new tax rates are going to be applicable. Hence, you must update your ERPs. MRP labels are to be restricted or relabeled, leading to compliance costs. So already the government has issued a parallel notification wherein that they have already told that the new MRP labels can be affixed on all these products, and those products and the packing materials and the labels can be utilized till 31st of December 2025. And the other changes that they are, if there are any difficulties and all, the government is ready to listen and then come out with their answers and all, that they have given that kind of an assurance. So there is a query also in the Q&A that I could see in the chat box that it is a very cumbersome process, that all products relabeling is going to be difficult. So how to do it? But the law is the way it is. Hence, there is no shortcut for it, or there is no exemption given. Hence, all products which are required to be labeled are can be relabeled as per this provision given. But without that, you cannot sell them. So that is going to be treated as a violation. And accumulated ITC reversal, it's required to be done where the goods are exempted. Say, for example, some product is taxed at 12% in the past, and from 22nd September 2025, it is going to be at zero rate. So whatever is the accumulated input credit is there, that has to be reversed. So because the goods are now going to be exempted. Mind you, sir, in this GST 2.0, they have not given any goods at a zero rate. They have either said that it is exempt or that they have put it under the 5% or 18% bracket. But there is nothing called a zero rate. Like exports are zero rated, wherein accumulated input tax credit need not be reversed. On top of it, it is going to be refunded. So, in such a way, when a product is now exempted, then it is not zero rated. So there is a subtle difference, and legally also, that you need to understand that if the product is exempt, means there is no tax that is payable, but it is not a zero tax. So when it is exempt, no tax need to be paid, then no credit can be retained. Contracts are to be revised to pass on the tax benefits and to avoid the anti-profiteering scrutiny. So when anti-profiteering has got its own sunset clause, then why we have to fear for the anti-profiteering scrutiny? That see, the government has formally given a sunset clause for the anti-profiteering, but that doesn't mean that the scrutiny will not happen, because time and again after the rate rationalization announcement, all the authorities are saying that we are going to pass on the tax benefits to the end customer, and they have to pass it on, otherwise that they are going to take action. So there may not be any legal provisions for them, but they can always come out with some or the other problem. Hence it is better that we do our work at home, and to the extent possible the tax benefits are extended to the end customer, because that is the intention of the government in doing this rationalization. So one must live up to their expectations. And suppliers need to be cautioned to extend the rate benefits downstream. And accumulated ITC encashment delays will expect can be expected in case of rate reduction. And lower tax rate without ITC may hurt in some cases, because some of the rates, if you see 5% without ITC, 5% without ITC is dangerous, and restaurant services are now at 5% without ITC. So whatever inputs that they buy, all the tax has to be loaded into the price, and on top of it, the consideration should be subjected to 5%. Similarly, the insurance sector, where the life insurance are completely exempt, health insurance for a person are completely exempt, but whatever the input side services that they will take, all those services are going to be a cost to them, the GST paid on those services, because they cannot pass it on in the form of output tax, because the service rendered by them, the final service rendered by them is exempt. So in such a scenario, it is going to have an impact on the pricing. No inverted duty system refunds for service sectors, which could create fresh disputes. So wherever the 18% inputs are there on the input side, input services, but the output service you render has become 5%, then it is going to take a longer time for you to exhaust the accumulation of the ITC, and sometimes it may not be, it may be difficult also. So there is no IDS refund for services sector, unlike for the goods. Hence, pure service players have must be having some issue that one needs to consider that also. So these are some of the initial thoughts on the new changes that were proposed. I think I have come to the end of my presentation.